All right. Well, thanks for joining me today. My name is Matt Ratliff. I am from InvestiQuant. We are a quantitative trading firm that uses quantitative data to do mostly day trading. We offer a few tools for back testing for the do-it-yourself type trader, as well as solutions for people that would like to have it done for them via an auto trading type of service. So we'll be talking a little bit more today about some educational topics. I'm not going to be trying to sell you anything. We're just going to spend a little bit of time here doing some education, and it'll be focused around short duration trading strategies and how they can benefit your portfolio. So before I get started here, just a quick moment to throw up the risk disclosure, make sure that we get this on the recording. And trading involves substantial risk of loss and is not appropriate for all investors. Past performance may not be indicative of future results. All right, so what we'll be talking about this afternoon is we're going to start with a little topic called crisis correlation that you may be finding that is something that you could be at risk of in your own portfolio right now without even knowing it. And then we'll talk a little bit about short duration strategies and how they can complement a buy and hold type of investor. I'll show you 3 ways to add active strategies to your portfolio, and then do a little segment at the end about traders for those of you who are more of the do-it-yourself type, give you a couple little tips there, and then we'll have a few minutes at the end. If there's any Q&A that needs to take place, we can do that at the end. All right, so the first thing we're going to talk about is a topic called crisis correlation. This is a risk for many investors, and this is a screenshot of a chart that came from a study. You can Google it if you're interested in learning more. A study is called a study of traditional asset correlation in the new millennium. And what it was looking at is what happens to traditional assets in times of crisis. So what they did was they studied different asset groups. Most people that put together their portfolio, they try to go along with a mix of different assets so that, if one of them doesn't do well for a period of time, hopefully there's something else that is doing well that can help offset the one that's not. And by doing that with a handful of different assets, then generally you can put together some pretty smooth returns. That's kind of the key to diversification. So what they did here is they put together a portfolio of small caps, gold, treasuries. They've got the NASDAQ in there, Hang Seng, the S&P 500. And what they found was during the 2008 Great Recession, there was very little benefit to being diversified. So in normal market conditions, they are diversified and they kind of do their own thing. Some of them make money, some of them don't. But in times of crisis, they all sold off together. And it becomes a real problem when you're expecting diversification to kind of hold your portfolio steady during those times where not everything is going well, and then all of a sudden they sell off at the same time. This one shows that they averaged a 31.6% decline during that period on the whole there, and it all just kind of happened at the same time. So their major takeaway was traditional asset groups become 2.5 times more correlated during times of market crises. And you see liquidity goes down quite a bit, which means that prices can fall even quicker when there's no liquidity on the other side of the market. People kind of panic. They sell now, ask questions later. And that's what you kind of see across the board. So this can be a real risk for traditional diversification, but there are some ways to get around that. So some of the solutions for crisis correlation, the first one that comes to mind is, you can just move the cash. And there are some benefits to that, but it also has several risks to it as well. And realistically, there's been studies that show most people that move to cash or most of the move that takes place by the time you move to cash is where all the damage is done. So 80% of the damage being done by the time the average investor would actually move to cash. And then there's some other risk there as well. But one of the better solutions, in our opinion, is by simply adding active short duration strategies to your portfolio. And that could be something like intraday strategies or shorter duration strategies, maybe just lasting a day or two. But there's several different benefits there. And that's a key benefit is that it's less correlated due to just simply not having as much exposure to the market. They can trade both ways. So not just being focused on the long side, they can also take advantage of the short side. And then there's some real benefits to market volatility as well for short-term trading. We'll take a look at that in just a moment. So the first advantage to these short duration strategies is the low correlation. In this table here, kind of a matrix that we've created here on the vertical axis, you've got correlation with stocks, with the top, the higher portion being a high correlation with stocks. Down at the bottom here, low correlation with stocks. And then on the horizontal axis, you've got a holding period. So very short-term holding periods versus very long-term holding periods. So if you look up here in the top right, buy and hold, that would have a high correlation with the overall market. And if you think about it, if you're always in the market, you're likely going to see basically the same results that the market is seeing. So of course, that's going to be very highly correlated. There in the middle is swing trading. Swing trading can be something where maybe you're holding for weeks or months at a time. And that can be a better way to go about it, where you can take advantage of pullbacks in the market that you look to buy for a rally and then sit out on the side for a while and wait for a new setup to take place. And that can be a good option for you as well. But what we focus on and what we've found to be more beneficial, at least for our style, is intraday trading, which is a short duration strategy. So it has extremely low correlation with stocks due to its very short time period that it's in the market. So shorter duration strategies, they don't spend very much time in the market. And if you're not in the market for very long, then you're not going to be exposed to the risk that take place in all of the markets. And that can help you to generate returns that are not correlated with the market. The second advantage is the ability to trade bi-directional. So everybody knows what trading long is. And if you're a buy and hold investor, you're simply buying and just letting it ride to the long side. But with short-term trading, you've got the ability to trade both long and short. So these are just a couple examples from trades that were taken in our auto trading portfolio that kind of give you an idea of what it would look like. But really the more interesting one, everybody has seen a long trade. You enter down here at the bottom, let it ride to the upside and get out. This one captured a move that lasted almost the entire session. So this would be an example of a longer day trade where you're entering around the open and getting out just a little bit before the close. But the short example, which was from just a couple of weeks ago, entered right near the open, and then it just took a quick move to the downside. This one only lasted about 45 minutes, but what it's really highlighting here is the ability to take advantage of moves that don't necessarily take very long, but they give you a good portion of the daily move. So this one took 45 minutes. You're only in the market for 45 minutes out of the day, captured the majority of the move. And then the rest of the day, you're just sitting in cash on the sidelines, which is a huge benefit to not have to be at risk while you're live in the market. You can sit in cash after you've taken advantage of a short period there. And that kind of really highlights that correlation there. If you're only in the market for that example 45 minutes, you're not going to have much correlation with stocks because there's just not much exposure to what's taking place. That's why it's got a very low correlation there. And then the third advantage is you can benefit from market volatility. So what you'll find in the markets is, generally speaking, a market that is moving up is not very volatile. You tend to get smaller ranges, and that's usually a great thing for a buy and hold investor. The market just kind of grinds its way higher. There's not a ton of big movement. It just tends to slowly creep higher. And we've seen a lot of that over the past handful of years. But if you do studies on daily ranges, and a daily range is simply looking at the difference between the high of the day and the low of the day. And that difference is the opportunity that takes place within the market. So on the table on the left, we've got the daily range of the S&P 500 for a down month. We've got the months January through December here, and then the average daily range for that month, what took place there. And you've got the total down here at the bottom versus an up month. And you can see there is quite a difference between the down months and the up months. The down months have a much larger average daily range, about 40% higher on average for the daily range compared to the up months. And that means you've got about 40% more opportunity in the daily session there, which the short-term traders can take advantage of. And the real benefit of that is, those are typically the markets where your buy and hold investments are not doing as well. So they're typically either going sideways or down. But with the short-term trading, you're able to take advantage of those moves on the downside as well. And not only do you get to take advantage of them, they typically end up being better opportunities. So a little bit beyond just talking stats there in theory, this is a table of how a live example of how day trading can outperform during those declining markets. And what we did was we put this table of the data going back to 2018 of every down month in the S&P 500. So it's got its worst down month to its smallest down month listed here. And then next to it, we've got the S&P 500 auto trading portfolio from IQ. And what we're showing here is how you can kind of take advantage of that volatility. And it doesn't mean that you're going to necessarily make money every time the market goes down. That's not necessarily true. But you can get lots of opportunity, which can result in huge outperformance when you need it most, which is when the market is going down. So generally speaking, we are able to beat the S&P 500 during those down months. And those are, kind of highlighted here in green. You can see that the months that are better, and there's certainly more that are better than those that got beat by the S&P in the down months. But the big key to it here, down at the bottom, if you just look at the worst or the down months since 2018 for the S&P 500, if you combine them all together, minus 65%, whereas a short-term trading portfolio that trades that same S&P was up 36% in real live trading, trading those same periods. So it is a huge benefit that is able to take advantage of the volatility as it increases. Stocks are declining, you're getting more opportunity, which kind of creates a hedge. It's not a perfect hedge, but it is a bit of a hedge to fight off some of the red in your portfolio during those periods. Some other benefits of short-term trading. We specifically here at InvestiQuant prefer index futures for short-term trading. There are some additional benefits of the futures versus stocks, but you're able to avoid overnight risk and surprises. If you were trading during COVID of 2020, the March period where the market was just selling off nonstop, and you would wake up in the morning and see that the market had hit circuit breakers. We were down 5%. And the market just halted, waiting for the open. You're able to avoid all of those types of risk and surprises that you certainly don't want to wake up to. And if you're trading the index futures, you can get around what's called a pattern day trader rule, which is something in stocks, but the futures don't have that problem. So you can trade as much as you want. If you're trading stocks, there is a limit on how much you can day trade without certain funding amounts. And then 1256 tax treatment. This is a benefit for index futures as well, where your tax treatment is lower. You're taxed on a 60% short-term or long-term rate and 40% short-term rate on all of your day trades or any of your trades. So there are some benefits there as well, especially if you're using the index futures. And then one of the most important is you can have your funds when you need them. They're not necessarily tied up into different investments that you need to close out of or wait for a time that you can exit. You can have your money when you need it, because by definition, you are on the sidelines the majority of the time. So it's easy to have access to your funds. All right, so how can you add short duration strategies to your portfolio? There's a few different ways. If you're a do-it-yourselfer and you've got time and money, which it certainly takes quite a bit of each of those, probably more time than you think, and realistically, probably more money than you think as well when you get started. But that is certainly an option, and there's ways to go about that and find and trade quantified edges of your own. The other way, if you're not someone that wants to spend thousands of hours digging into it and really learning it and trying to master it, and realistically, you do need to plan on quite a bit of time. Malcolm Gladwell talks about the 10,000 hour rule. That's probably in the right ballpark. If you want to be a professional trader, you need to really consider the significant amount of time that you need to put into it and focus on it. So if you're not someone that wants to do that, you can certainly outsource, and we can look at a couple of those options as well here in just a moment. So if you want to do it yourself, there's a couple things that you need to be prepared for that not everybody is aware of when they first get started. And that's a couple of the reasons why most traders are not able to make it. And those reasons are trading without an edge, thinking you have an edge, but maybe not actually having an edge. And it's easy to be fooled by some randomness of distributions of returns that makes it difficult to really know what your edge is. And then some unrealistic expectations as well can make you think things that get you pretty discouraged when they don't play out, and can actually lead you to abandoning good strategies just because you don't quite have the expectation of what the edge is and what it should look like in real trading. All right, so let's take a quick look here at an example and tell me, do you think this is a strong edge? So this is a strategy for the S&P 500, trades the ES. It's got a 60% win rate, a profit factor, which is a measure of profitability, of 2.03. And it stands to make about twice as much as at risk on any trade. Equity curve there, going from lower left to upper right, looks pretty good on the outside. Without seeing anything else here, this looks pretty strong. But if I go to the next slide, I'm going to show you how you can be fooled by randomness. And that was just a section of this overall equity curve. So when people get started with trading, one of the things that you really need to do is test your edges before you trade them. And if you don't have access to a quantitative platform like you can see here, or TradeStation, something like that, to really be able to code and study your edges, the best thing to do is to just paper trade as you see your setups in real time, record your results. And then after you get enough samples, that you can rely on, then you can try it live and see how it goes. But you can fall into the trap of just finding some random edges that happen to work while you're doing your test, and long term, there's nothing really there to back it up. So that little equity curve that I showed just above is circled here in the orange. And you can see, if you look at it in that little section, that was great. There's a couple other pieces here of this equity curve that had nice, strong runs. You can see here from 2011 up to 2015 was pretty consistent as well. There was a nice little section here around 2004 to 2008 or so that was pretty strong, but realistically, there's no edge in this. It is just completely random. And if you had been, basing your strategy going live after just seeing that section of it, you really would have been disappointed in what the results are by going off of those kind of random distributions of results here. So it can make it really hard to distinguish what real edges are if you don't have good data to lean on, good long-term data. So that's something you've got to be aware of. The other mistake is simply having unrealistic expectations. And if you've had any success trading, then you've probably fallen into the trap of unrealistic trading expectations. I know I certainly did when I first got started. You start with a decent little winning stretch, and then you start doing the trader math on it. If I can make a little bit of money each day, say I make $500 a day, then I multiply that times the days that I can trade in a year, and all of a sudden I've got a six-figure income doing what everyone wants to do and loves doing. But realistically, probably not going to happen that way. And it's probably going to end up taking more money than you think it is to be able to create good, strong results. And it's probably not going to be nearly as linear as you hope or expect it to be either. And if you don't have access to real good information about your edge, to know the expectation of your edge, is it something that makes money every month? Is it something that makes money 3 months out of the year, and the rest of the time it just kind of chops sideways? There's strategies that do that. They make big money on certain moves, and then the rest, they just kind of chop around and wait for the volatility to be just right, or whatever it is that really sparks the profitability of it. And if you don't know that's kind of how your edge works, you're going to be really disappointed when you go to trade it and you're not seeing just weekly income or monthly income coming from it. And that's a real discouragement as you're trading and you're expecting to see money come in that's just not there. And then it may actually cause you to walk away from a strategy that is profitable, that has a nice long-term edge, but you don't know how it actually plays out over time. So you abandon it. And then what always happens, especially if you've done this for a while, is you come back to look at it and see that, you probably should have just stuck around and you missed out on what would have been the next run up. So the solution is to trade robust quantified edges, and you get that data by doing lots of testing and digging into the data. So only trade edges and strategies that have verifiable and quantified historical results. And if you've ever heard Scott Andrews from InvestiQuant talk, he often talks about the 3 C's when you're building trading strategies based on quantified edges. And that is something that's causative, which means there's some sort of logic behind whatever it is that you're looking at that is causing the move to happen, that is causing the edge to play out. There's something that actually causes it. And then also looking at the context, looking at is the market, in a strong bullish trend, or is it a bearish trend, sideways range, whatever it is. But considering the market, does it work in that type of market, or is it just Is it just a bull market strategy? Is it something that works in all markets? Whatever, you need to be able to test the context of it and make sure that that is going to work as well. And then lastly, to confirm it. And the way we like to confirm is using different markets or different time frames. So an example of a different market is, does the strategy for your S&P strategy, does it work in the Dow as well, or does it work in the NASDAQ? Looking at different markets, or sometimes you can look at different time frames for it as well. And you can do this type of research with many of the popular backtesting solutions. TradeStation probably has the best name recognition out there for this type of solution that you would need to do that backtesting. NinjaTrader is another one. You need to be able to code in both of those. I believe Ninja is a C#. TradeStation uses their own language called Easy Language that you could code in. Python, that's what our developers here really like to use. It's a little bit better trading language, and it's more for coders as opposed to people like me. I can kind of hack around in TradeStation, but Python's above my pay grade. Or if you're not a coder, we have a platform which was shown in that screenshot above, where you don't have to be able to code. It's just kind of a point and click thing, and it's code-free backtesting, but that would be available with the Discover platform from InvestiQuant. Now, if you're not a trader and you want access to short-term strategies, there are some other options as well, and that would be to outsource. So if you're going to outsource, the most popular way to do that, to get those short-term strategies, is going to be something like a hedge fund. Now, they are difficult to get into some of the better ones, which is a little bit of a hindrance there. Sometimes there's pretty sizable minimums to get into them. Or there's also what's called commodity trading advisors, where they can manage your account separately versus a hedge fund, which is typically like a pooled investment, where maybe there's a lockup period or something like that. But CTAs would be another option. They are not always as difficult as a hedge fund to get into. And they would have auditable track records that you would be able to look at. In fact, the one on the right is a CTA index from SocGen. Their short-term traders index. It hasn't done all that well recently, but it's up 10% or so over the past handful of years, which is not the most impressive, but that would be something you could look at. If you are going to go the hedge fund route, the CTA route, a couple things that you would want to ask them before getting started is ask them about, are they holding leveraged positions overnight? You don't want to be waking up to those circuit breaker days, which can be pretty scary. Ask for their track record. That's not something that would be hard to get at all. They're going to have auditable track records available. The minimum requirements to get in is something you'll need to ask about. And then the lockup period is one that you would want to ask about as well. So a lockup period would be something that hedge funds and CTAs sometimes have as well, that will kind of force you to keep your money invested with them for, you may have to give them like a 30-day heads up or 90-day heads up before you could get your money out. And it's a way for them to be able to protect some of their positions. Honestly, it's a smart thing for them. They don't want to just have to blow out of positions because somebody needs their money and then screw up their overall weightings of holdings and that sort of stuff. So it is something that is needed for the funds, but it's something you'll need to be aware of. And then the other option would be to license a third party to trade your account, a system developer, which is more of what we do at InvestiQuant. And if that's something you're interested in, you'll want to ask some similar questions as well. Do you hold leveraged positions overnight? Again, you probably don't want to be setting yourself up for that risk where you're waking up to a margin call. So if they're holding leveraged positions overnight, that is a risk. You can ask about track records. and specifically, can they verify them? The CTAs and hedge funds will have an easier time verifying them because they're registered. But if you go to a third party, they're not registered entities. So the way we suggest doing it is have their broker verify that the returns that they show are the returns that they actually have in their account, and it's not just some funny business with Adobe or something like that to put up a fake track record. So ask their broker for that information. And then lastly, do the clients get the exact same returns that are being published? Just to make sure that you're going to be seeing exactly what it is that they're showing. All right, so that is educational portion here. If you guys are interested in anything that we offer a auto trading program where we day trade the S&P, and it's something that you can participate in if that's something that you are interested in getting some exposure to short-term strategies. We have that as an available offer. You can learn more about it. We're not selling anything here, so if you go to that link at the bottom, you can find out more information about that. That's InvestiQuant.com/learn more. We also have a Discover platform, and Discover platform, I had a screenshot in there, which will allow you to do quantified research without needing to code. That is a very powerful tool for an intraday trader. It is an intraday focused platform, but there's all kinds of cool stuff in there to be able to build trading strategies if that's something that you want to do. The Discover platform has thousands of different ways to code up different trading ideas, and the results are pretty much instant. And then we also have our IQ edges, which will give you signals based upon our predictive analytics. So those are a few of the things that we do. If you want to learn more about any of those, at InvestiQuant.com/learn more, we even got a free white paper there, which we'll talk a little bit about diversification as well. That is available. There's nothing on that link to buy. It's just to request more information. So if any of that sounded of interest to you, you can go to that link and learn more. One of the questions here is asking, does the auto trading program trade every day? No, the auto trading program does not trade every day. It trades about every other day, depending on market conditions, but it waits for the right opportunities to trade. So it comes out to about half the trading days it'll have a trade, and then the other days it doesn't. So that kind of helps it to not be as correlated with the market as well. All right, if there's not any other questions, that is all I am sharing for today. I'm happy to stick around for a couple minutes if anybody has questions. But otherwise, I am done with this part of the presentation.